Question 1. New Mexico captive insurance laws and regulations. Which of the following statements best reflects the compliance requirements for a captive insurance company in New Mexico? A. Captive insurers are required to submit only audited financial statements every 3 years. B. Captive insurers must maintain minimum surplus levels as prescribed by New Mexico law and submit annual financial reports to the Office of Superintendent of Insurance, OSI. C. Captive insurers are exempt from the governance requirements applicable to traditional insurers in New Mexico. D. Captive insurers are required to hold quarterly meetings with stakeholders, including OSI representatives, to discuss their financial performance. Answer: B. Explanation. Option B correct. New Mexico law mandates that captive insurers maintain minimum surplus requirements to ensure financial stability and solvency. Captive insurers must also submit annual financial statements and other necessary reports to the OSI, as stipulated under the New Mexico Insurance Code. Option was incorrect. Financial reporting is not limited to every 3 years. Captive insurers must comply with annual reporting requirements. Option C incorrect. Captive insurers are subject to governance requirements, including compliance with statutory rules on board composition and corporate governance. Option D incorrect. Quarterly meetings with stakeholders are not mandated by New Mexico regulations. Annual reporting suffices unless otherwise required by OSI. This reflects the regulatory emphasis on ensuring transparency and accountability in captive operations. Question 2. Scenario-based question. Risk management and actuarial practices. MS. Franklin is the risk manager for a New Mexico-based captive insurer that provides liability coverage to a group of healthcare facilities. Recently, a large medical malpractice claim was filed, and MS. Franklin is assessing whether to retain this risk or transfer it through reinsurance. The captive has a well-capitalized reserve, but has not yet modeled the potential impact of similar claims in the future. What should MS. Franklin prioritize in this situation? A. Retain the risk since the captive is well capitalized, avoiding additional costs associated with reinsurance. B. Purchase reinsurance immediately even without analyzing the long-term impact of similar claims. C. Conduct catastrophe modeling and stress testing to evaluate the potential impact of similar claims before deciding on risk retention or transfer. D. Delay making a decision until more claims data becomes available to ensure accuracy in future projections. Answer: C. Explanation. Option C correct. Conducting catastrophe modeling and stress testing is essential to assess the potential financial impact of similar claims. This aligns with risk management best practices and allows informed decisions regarding risk retention or transfer. Option 1 incorrect. While the captive is well capitalized, relying solely on reserves without assessing long-term risks could lead to insolvency in extreme scenarios. Option B incorrect. Purchasing reinsurance without evaluating the potential claim impacts may result in unnecessary costs and inefficient risk transfer. Option D incorrect. Delaying decisions can expose the captive to significant risks and may result in regulatory non-compliance. This question emphasizes the importance of actuarial methodologies in risk management. Question 3. Formation and structure of captive insurance companies. Which of the following is a key advantage of a protected cell captive (PCC) structure compared to a traditional single-parent captive? A. PCCS allow multiple insured parties to share the same risk pool, reducing administrative costs. B. PCCS provide legal segregation of assets and liabilities between cells, reducing the risk of cross-contamination. C. PCCS are exempt from minimum capital requirements under New Mexico law. D. PCCS are designed to operate exclusively without the involvement of third-party service providers. Answer: B. Explanation. Option B correct. Protected cell captives offer legal segregation between cells, ensuring that the assets and liabilities of one cell do not impact others. This structure provides flexibility and minimizes risk for each participant as recognized under New Mexico law. Option was incorrect. While PCCS may reduce costs, they do not necessarily involve shared risk pools. Each cell typically operates independently. Option C incorrect. PCCS are not exempt from capital requirements, so they must comply with minimum thresholds as determined by regulators. Option D incorrect. PCCS often utilize third-party service providers for management, auditing, and actuarial services to ensure regulatory compliance and operational efficiency. This question highlights the structural and operational nuances of PCCS in the captive insurance framework. Question 4. Taxation and accounting for captives. Which of the following statements regarding the IRS 831B election for small captives is accurate? A. The IRS 831. B. Election allows captives to exclude premium income from taxation, regardless of whether the premiums meet risk distribution requirements. B. Captives electing IRS 831. B. Must limit annual premium income to $2.4 million or less, with adjustments for inflation. C. Captives under IRS 831. B. Can claim exemptions from all federal tax liabilities, including taxes on investment income. D. The IRS 831-B election applies exclusively to captives domiciled in offshore jurisdictions. Answer B. Explanation. Option B correct. The IRS 831-B election permits small captives to exclude premium income from federal taxation, provided that the annual premium income is within the specified limit, $2.4 million, adjusted for inflation, risk distribution, and proper management of the captive are critical compliance factors. Option was incorrect. Risk distribution is a requirement for the election to apply. Without it, the captive may face penalties or denial of the tax benefit. Option C incorrect. The election does not exempt captives from taxes on investment income, which remains taxable. Option D incorrect. The election is available to captives domiciled in the U.S., including New Mexico, as long as they meet the eligibility criteria. This reflects the balance between tax benefits and compliance requirements for small captives. Question 5. Operational management of captives. What is the primary role of a captive manager in the operation of a captive insurance company? A. Setting the captive's overall investment policy and directly managing its financial portfolio. B. Ensuring compliance with regulatory requirements and overseeing day-to-day operations, including reporting and policy issuance. C. Arbitrating disputes between policyholders and the captive's reinsurers. D. Representing the captive in all legal matters, including litigation defense. Answer B. Explanation. Option B correct. A captive manager oversees operational compliance, ensures proper reporting to regulatory authorities, and manages daily administrative tasks, such as issuing policies and processing claims. This role is critical for maintaining the captive's operational efficiency and regulatory adherence. Optional incorrect. While captive managers may assist in investment oversight, the responsibility for setting investment policy typically lies with the board of directors or financial advisors. Option C incorrect. Arbitration is not a primary role of the captive manager. It involves specialized legal or insurance arbitration professionals. Option D incorrect. Legal representation is the role of attorneys, not the captive manager. This underscores the multifaceted responsibilities of captive managers in ensuring the smooth operation of the captive. Question 6. Scenario-based question. Financial management of captive insurance. Dr. Morales is the CFO of a group captive insurer in New Mexico that provides property insurance for a consortium of small businesses. The captive is evaluating its solvency ratio after recent wildfire caused significant property damage. Financial data indicates that the wildfire claims exceeded the expected loss reserves by 30%. What should Dr. Morales focus on to ensure compliance with New Mexico's solvency requirements? A. Use surplus funds to pay all claims immediately, regardless of future solvency implications. B. Secure reinsurance coverage retroactively to transfer the excess claim costs to a reinsurer. C. Conduct a risk-based capital analysis to assess solvency impacts and consider options like capital infusion or adjusting premiums. D. Postpone claim payments until additional reserve funds are accumulated from future premiums. Answer C. Explanation. Option C correct. A risk-based capital RBC analysis is critical to evaluate the financial impact of the wildfire claims on the captive solvency. Dr. Morales should explore strategies such as seeking capital infusion from members or adjusting premiums to restore financial stability while maintaining compliance with New Mexico's solvency standards. Option was incorrect. Depleting surplus funds without a plan for future solvency can lead to regulatory violations. Option B incorrect. Reinsurance coverage cannot typically be secured retroactively. It must be arranged in advance. Option D incorrect. Delaying claim payments is unethical and could breach contractual obligations, exposing the captive to litigation. This scenario emphasizes financial resilience and compliance strategies in the face of unexpected losses. Question 7. Risk management and actuarial practices. What is a key factor considered when determining loss reserves for a captive insurer? A. The captive's gross premium income for the prior fiscal year. B. Historical loss data and trends, including incurred but not reported IBNR claims. C. The number of policyholders currently insured by the captive. D. The captive's total investment portfolio value. Answer B. Explanation. Option B correct. Loss reserves must account for historical loss data and trends, including IBNR claims, to ensure accurate estimation of liabilities. These reserves are critical for assessing the financial health of the captive. Option was incorrect. Gross premium income is unrelated to specific loss reserve calculations, though it influences broader financial planning. Option C incorrect. The number of policyholders does not directly impact reserve levels, as reserve calculations are based on claims data. Option D incorrect. Investment portfolio value is not a factor in calculating loss reserves, though it supports overall financial stability. This question highlights the actuarial precision required in reserve calculations. Question 8. Formation and structure of captive insurance companies. Which of the following is an advantage of domiciling a captive insurer in New Mexico? A. New Mexico offers complete exemption from premium taxes for captive insurers. B. The state has competitive minimum capital requirements and a supportive regulatory environment. C. New Mexico mandates a single financial reporting format, reducing administrative complexity. D. Captive insurers in New Mexico are not subject to state solvency requirements. Answer. B. Explanation. Option B correct. New Mexico is known for its competitive minimum capital requirements and a regulatory framework designed to attract captive insurers. These advantages make it a favorable domicile for captive insurance companies. Option was incorrect. Premium taxes may apply, though rates may be lower than traditional insurers. Option C incorrect. Captives in New Mexico must comply with detailed reporting obligations, often requiring multiple formats. Option D incorrect. Captive insurers must comply with state solvency requirements to ensure financial stability and protection of policyholders. This question emphasizes the strategic considerations in domicile selection. Question 9. Emerging trends and challenges. Which emerging trend is likely to impact the captive insurance market in New Mexico? A. Increased reliance on traditional insurance markets for risk retention. B. Growth in captive structures focused on cyber risk and ESG initiatives. C. Elimination of minimum capital requirements for captives across all U.S. states. D. Reduction in the use of actuarial methods for rate development due to advancements in AI. Answer. B. Explanation. Option B correct. Cyber risk captives and ESG-focused captives represent significant trends as organizations seek specialized solutions for modern challenges. New Mexico's regulatory flexibility can accommodate these innovative captive models. Option incorrect. Captive insurance is increasingly preferred for specialized risks, not traditional insurance markets. Option C incorrect. Minimum capital requirements remain essential for solvency and regulatory compliance. Option D incorrect. Actuarial methods remain foundational, with AI complementing rather than replacing these practices. This question reflects the evolving landscape of the captive insurance industry. Question 10. Legal and ethical considerations. What is a key ethical obligation of a captive insurer's board of directors? A. Prioritize the interests of the captive shareholders over policyholders. B. Ensure that the captive operates transparently and complies with applicable laws and regulations. C. Limit communication with regulatory authorities to avoid over-disclosure of operational challenges. D. Delegate all compliance responsibilities to external service providers. Answer. B. Explanation. Option B correct. Ethical practices and regulatory compliance are critical obligations of the board of directors. Transparency with stakeholders, including policyholders and regulators, ensures trust and alignment with legal requirements. Option is incorrect. The board must balance the interests of shareholders and policyholders, adhering to ethical standards. Option C incorrect. Avoiding communication with regulators could lead to penalties and reputational damage. Option D incorrect. While service providers can assist, ultimate responsibility for compliance rests with the board. Question 11. Regulatory oversight in captive insurance. Which of the following best describes the role of the New Mexico Office of the Superintendent of Insurance in regulating captive insurers? A. It sets premium rates for all captive insurers in the state. B. It ensures compliance with state laws, oversees financial solvency, and reviews annual filings. C. It provides direct operational management services to captives based in New Mexico. D. It mandates that all captives follow a uniform risk management strategy. Answer. B. Explanation. Option B correct. The Office of the Superintendent of Insurance regulates captives by ensuring they comply with state laws, maintain financial solvency, and file accurate annual reports. Optional incorrect. Captive insurers typically set their own rates based on their business model. Option C incorrect. The office does not manage captives. It provides regulatory oversight. Option D incorrect. Captives have the flexibility to develop customized risk management strategies. Question 12. Types of captives. What is a primary feature of a pure captive insurance company? A. It insures risks for unrelated third parties. B. It insures the risks of its parent company and affiliated entities. C. It pools risks from multiple unrelated organizations to reduce costs. D. It focuses exclusively on providing reinsurance for traditional insurers. Answer. B. Explanation. Option B correct. A pure captive insures the risks of its parent company and affiliated entities, offering tailored coverage solutions. Option is incorrect. This describes an agency or association captive. Option C incorrect. This is a feature of group or association captives. Option D incorrect. Pure captives may provide reinsurance, but that is not their primary focus. Question 13. Risk retention and captive insurance. Which of the following is a benefit of retaining risks through a captive insurance structure? A. Reducing exposure to market volatility by transferring all risks to reinsurers. B. Enhancing cash flow by retaining underwriting profits within the captive. C. Eliminating regulatory requirements associated with insurance companies. D. Avoiding the need for actuarial analysis in premium setting. Answer. B. Explanation. Option B correct. Retaining risks through a captive allows the organization to keep underwriting profits, which can enhance cash flow and fund future losses. Option is incorrect. Captives retain some risks instead of transferring all risks to reinsurers. Option C incorrect. Captive insurers are still subject to regulatory oversight. Option D incorrect. Actuarial analysis is critical in captive insurance for setting appropriate premiums. Question 14. Scenario-based question. Claims management. A New Mexico-based captive insurer receives multiple large claims after a natural disaster. The claims exceed its projected loss reserves. The captive's reinsurance agreement covers catastrophic losses but has a $500,000 attachment point. What is the most appropriate course of action for the captive's claims manager? A. Negotiate a reduced payout with claimants to avoid depleting reserves. B. Pay claims up to $500,000 and file a reinsurance claim for losses exceeding this threshold. C. Suspend claim payments until the board reviews the financial impact. D. Increase premium rates retroactively to cover the excess claims. Answer. B. Explanation. Option B correct. The captive should honor claims up to the reinsurance attachment point and then utilize its reinsurance coverage for excess losses. Option incorrect. Negotiating reduced payouts may breach contractual obligations. Option C incorrect. Suspending payments can damage the captive's reputation and legal standing. Option D incorrect. Premium rates cannot be adjusted retroactively. Question 15. Investment strategies for captives. What is a key consideration when developing an investment strategy for a captive insurer? A. Maximizing short-term returns at the expense of liquidity. B. Ensuring investments align with regulatory requirements and liquidity needs. C. Avoiding diversification to concentrate on high-growth sectors. D. Prioritizing speculative investments to boost financial reserves. Answer. B. Explanation. Option B correct. Captive insurers must balance returns, liquidity, and regulatory compliance in their investment strategies. Option incorrect. Liquidity is essential for meeting claims obligations. Option C incorrect. Diversification reduces investment risk. Option D incorrect. Speculative investments are risky and often restricted by regulations. Question 16. Reinsurance in captive insurance. Why might a captive insurer in New Mexico purchase reinsurance? A. To increase regulatory scrutiny of its operations. B. To transfer high-severity risks and protect its capital base. C. To eliminate the need for maintaining loss reserves. D. To avoid compliance with state insurance laws. Answer. B. Explanation. Option B correct. Reinsurance allows captives to transfer high-severity risks, reducing their exposure and protecting their capital base. Option is incorrect. Reinsurance reduces, rather than increases, direct exposure to risk. Option C incorrect. Captives must still maintain adequate loss reserves. Option D incorrect. Compliance with state laws remains mandatory. Question 17. Key functions of actuaries in captive insurance. What is a primary role of actuaries in a captive insurance company? A. Marketing the captive services to potential members. B. Estimating loss reserves and determining appropriate premium rates. C. Overseeing daily claims processing and payments. D. Negotiating reinsurance treaties with external providers. Answer. B. Explanation. Option B. Correct. Actuaries are responsible for assessing risks, estimating loss reserves, and calculating premiums, ensuring financial stability. Option A. Incorrect. Marketing is not an actuarial function. Option C. Incorrect. Claims processing is managed by claims departments, not actuaries. Option D. Incorrect. Reinsurance negotiations are typically handled by management or brokers. Question 18. Captive insurance feasibility studies. What is the purpose of conducting a feasibility study before forming a captive insurer? A. To eliminate the need for state regulatory approval. B. To assess the financial and operational viability of the proposed captive. C. To avoid the requirement of securing reinsurance agreements. D. To ensure that the captive is exempt from federal tax regulations. Answer. B. Explanation. Option B. Correct. A feasibility study evaluates whether forming a captive is financially and operationally viable, considering factors like risk profile and cost-benefit analysis. Option A is incorrect. Regulatory approval is still required. Option C. Incorrect. Reinsurance agreements may still be necessary. Option D. Incorrect. Tax exemptions depend on compliance with federal tax laws. Question 19. Board of Directors responsibilities. What is a key responsibility of the Board of Directors in a captive insurance company? A. Setting state regulatory policies for captive insurance. B. Approving the captive strategic plan and overseeing its implementation. C. Managing the daily operations of the captive. D. Drafting reinsurance contracts for the captive. Answer. B. Explanation. Option B. Correct. The Board of Directors provides governance, approves strategic plans, and monitors the captive's performance. Option A. Incorrect. Regulatory policies are set by state authorities, not the board. Option C. Incorrect. Daily operations are handled by management and staff. Option D. Incorrect. Reinsurance contracts are drafted by legal and risk management professionals. Question 20. Regulatory filings. What is one of the mandatory annual filings for a captive insurer? In New Mexico, A. An audited financial statement prepared by an independent auditor. B. A marketing report detailing premium growth strategies. C. A report on the personal financial status of the board members. D. A quarterly update on the captive solvency ratio. Answer. A. Explanation. Optionals are correct. Captive insurers are required to submit audited financial statements annually to demonstrate financial stability and compliance. Option B. Incorrect. Marketing reports are not typically required. Option C. Incorrect. Personal financial details of board members are not part of the filing requirements. Option D. Incorrect. Quarterly solvency updates are not mandatory unless specified by the regulator. Question 21. Captive insurance tax benefits. Which of the following is a potential tax benefit for a captive insurance company? A. Complete exemption from federal income taxes on underwriting profits. B. Tax-deductible premium payments made by the parent company. C. Avoidance of any state taxes on reinsurance agreements. D. Retroactive adjustments to prior year's tax filings for increased deductions. Answer. B. Explanation. Option B. Correct. Premiums paid to the captive by the parent company may be tax deductible if the captive meets regulatory and legal requirements. Option A. Incorrect. Captives may be taxed on profits unless they qualify for specific exemptions. Option C. Incorrect. State taxes on reinsurance agreements may still apply. Option D. Incorrect. Tax regulations generally do not allow retroactive adjustments for captives. Question 22. Types of captives. Which type of captive insurance company is owned by multiple organizations and designed to provide coverage for its members? A. Pure captive. B. Group captive. C. Rent-a-captive. D. Protected cell captive. Answer. B. Explanation. Option B. Correct. Group captives are owned by multiple entities and offer coverage to their members, sharing costs and risks. Option C. Incorrect. Pure captives serve a single parent company. Option C. Incorrect. Rent-a-captives provide coverage to organizations that rent access to the captive services. Option D. Incorrect. Protected cell captives divide assets and liabilities into separate cells for different participants. Question 23. Scenario-based question. Premium allocation. A captive insurer is reviewing premium payments from its parent company. The parent company operates in multiple states and allocates premiums based on risk exposure in each location. What is the most critical consideration when allocating premiums? A. Ensuring premiums are distributed equally across all states. B. Aligning premium allocation with the specific risk exposures of each state. C. Reducing premiums in high-risk states to attract more business. D. Avoiding premium allocation to states with strict regulatory requirements. Answer: B. Explanation. Option B correct. Premiums must reflect the actual risk exposures in each state to ensure compliance and adequate coverage. Optional incorrect. Equal distribution disregards differences in risk levels. Option C incorrect. Reducing premiums in high-risk states compromises solvency. Option D incorrect. Avoiding allocation to regulated states violates insurance principles. Question 24. Formation costs. What is a typical cost associated with forming a captive insurer? A. Loss reserve contributions for future claims. B. Marketing expenses to promote the captive to external clients. C. Penalty fees for withdrawing from traditional insurance programs. D. Compliance fees paid to reinsurers. Answer A. Explanation. Optionals are correct. Initial funding includes contributions to loss reserves to ensure the captive can cover future claims. Option B incorrect. Marketing is not a primary cost for captive formation. Option C incorrect. Transitioning to a captive may involve other costs, but penalties are uncommon. Option D incorrect. Compliance fees are typically paid to regulators, not reinsurers. Question 25. Risk retention grower IGS. Which of the following is a defining characteristic of a risk retention grower RG? A. It can provide any type of insurance, including life insurance. B. It must be licensed in every state where it operates. C. It is owned by its members, who share similar liability risks. D. It is required to purchase reinsurance for all policies issued. Answer C. Explanation. Option C correct. RIGS are owned by members with similar liability exposures and focus on providing liability coverage. Optional incorrect. RIGS cannot provide life insurance. Option B incorrect. RIGS are licensed in one state but may operate in others under federal laws. Option D incorrect. Reinsurance is not mandatory but may be used for risk management. Question 26. Protected cell captives. What is a primary advantage of a protected cell captive PCC? A. Eliminates the need for regulatory reporting. B. Offers asset and liability segregation between cells. C. Allows unrestricted access to capital markets. D. Guarantees tax exemptions for all participants. Answer B. Explanation. Option B correct. PCCS segregate assets and liabilities, ensuring the financial independence of each cell. Optional incorrect. PCCS are still subject to regulatory oversight. Option C incorrect. Access to capital markets depends on the cell's structure and jurisdiction. Option D incorrect. Tax exemptions are not guaranteed and depend on regulatory compliance. Question 27. Claims management best practices. Which of the following is considered a best practice in claims management for a captive insurer? A. Outsourcing all claims handling to third-party administrators. B. Maintaining detailed records of claims and analyzing trends. C. Denying claims that could impact the captive's financial reserves. D. Settling all claims quickly without investigating their validity. Answer B. Explanation. Option B correct. Maintaining detailed records and analyzing trends helps captives improve risk management and reduce future claims. Optional incorrect. While outsourcing can be useful, the captive should retain oversight. Option C incorrect. Claims should be evaluated fairly based on merit, not financial impact. Option D incorrect. Investigating claims ensures accuracy and prevents fraud. Question 20. Capital requirements. What determines the minimum capital requirements for a captive insurer? In New Mexico, A. The insurer's annual profit projections. B. The level of risk retained in state regulatory guidelines. C. The number of employees within the captive organization. D. The volume of claims filed in the previous fiscal year. Answer B. Explanation. Option B correct. Capital requirements are based on risk exposure and regulatory guidelines to ensure financial solvency. Optional incorrect. Projections do not dictate capital requirements. Option C incorrect. Employee numbers are irrelevant to capital requirements. Option D incorrect. Claims volume may influence reserves but not minimum capital. Question 29. Economic benefits of captives. How can forming a captive insurer benefit a parent company economically? By eliminating all regulatory compliance costs. B. By retaining underwriting profits and improving cash flow. C. By avoiding the need for loss prevention programs. D. By guaranteeing lower costs than traditional insurance. Answer B. Explanation. Option B, correct. Retaining underwriting profits within the captive enhances cash flow and provides economic benefits. Option were incorrect. Regulatory compliance costs still apply. Option C, incorrect. Loss prevention remains essential for minimizing risks. Option D, incorrect. Costs depend on the captive's management and risk profile. Question 30. Exit strategies for captives. Which of the following is an appropriate exit strategy for a captive insurer? A. Selling the captive to unrelated third parties. B. Merging with another captive to consolidate operations. C. Closing the captive and transferring liabilities to a reinsurer. D. Ignoring regulatory obligations after ceasing operations. Answer C. Explanation. Option C, correct. Transferring liabilities to a reinsurer ensures claims obligations are met, facilitating an orderly closure. Option will incorrect. Captives are typically not sold to unrelated parties. Option B, incorrect. Mergers may be an option but are less common as exit strategies. Option D, incorrect. Compliance with regulatory requirements remains mandatory.